Hello, this is Eugene Lopin with Commercial Deals, welcoming SBA lender George Harrop of CapitalSource to our second Q&A together. George, don't you have anything better to do?
On a Friday afternoon at 65 degrees in February, I can think of a couple things I'd rather be doing, but I'm happy right here with you.
Okay, great. Well, since we have you, tell us, what are the recent developments for the SBA 7A program under the new legislation?
Yeah, there are a couple things that that I think are good permanent changes. As your listeners may know, there was a fee waiver for the SBA program on SBA 7A loans that has expired at the end of the year. So that fee waiver is not currently in effect. And the best thinking, I just came back from an SBA conference yesterday, and there's really no thinking that that is going to be reinstated. It's likely that that was just part of the Stimulus Act, and so probably will not come back. But the biggest change, I think, in the 7A program, which is really very valuable, especially for people trying to finance commercial real estate, is that the SBA has permanently increased the size of an SBA 7A loan from what used to be $2 million, which was the cap, up to $5 million. And that opens up a whole new spectrum of borrowers to the SBA program. And I think that's probably the biggest change that people are really going to see an impact with.
You know, brokers are very upset about losing the fee waiver. Can't you flex your muscle in front of Congress, George?
I can jump on the Metro and go down to Capitol Hill. I'm just right here in Washington, D.C., but I'm not sure it would do any good.
And what does the new legislation mean for the 504 program?
Well, the biggest change there is an increase in the size of a 504 loan. The way a 504 loan works is that there is an SBA 7A loan is a loan that's made by a lender. So if your borrower goes to a bank to get a loan, they're not getting a loan directly from the SBA, they're getting a loan from the bank. But a portion of that loan, 75%, is guaranteed by the government, and it's an inducement for the bank to make a loan which they might consider to be a little risky for them otherwise. And as you know, in the last 2 years, banks have been very risk averse. So this program, I think, is particularly valuable to borrowers because it can help banks get a little more comfortable making small business loans. The 504 program is a little different in that it's a program where the government has regional offices that are nonprofits, and they actually partner with banks to make loans. Now, these loans have to be for the acquisition of real estate or for plant and equipment. They can't be used for working capital, that sort of thing. So a SBA 504 loan, a typical structure would be that the borrower puts in 10% of the loan amount, the bank makes a first trust loan for 50%, and then the nonprofit that represents the SBA makes a 40% loan in a second place position. So it's a 50, 40, 10, 50% by the lender, 40% LTV by the bank, and 10% by the borrower. And the neat thing about that is that the borrower does not have to put a lot of money down in order to get a very good transaction, and the CDC piece, the government piece, is at a fixed rate. What the government does is they pool all these loans every month, and they float a bond, and that's how they fund the program. So currently the rates, and I haven't checked in the latest for February, but the rates are right around 5%, 5.25%, and that's a fixed rate. So the nice thing about that program is that you can buy. Let's say that you wanted to buy a warehouse or a manufacturing plant where you were operating. It cannot be an investor use. You could not buy an apartment building with this and be an investor. You would have to be the small business actually doing the operating the business. And so if you did that, you could have a very nice fixed rate for that 40% piece. You'd put 10% down, and then the bank would typically do, it can be done fixed rate, but often it's done variable rate for the 50% piece. And those loans with the new legislation can go up to $12.5 million. So if you imagine, that's really quite a large financing.
Is SBA financing available for a property that the borrower is not local to? Let's say we have a borrower looking to refinance a property in Louisiana, having a full-time property manager on site, but lives in California.
Typically not. Certainly, I'll speak for CapitalSource. We like to have our borrowers be involved in the business as opposed to passive investors in the business. If there was a partnership where one of the partners was living on site and one of the other partners was not, that would be a different situation. But typically, and let me make I want to make a distinction here also. With the exception of the 504 program, which, as I mentioned, is for the acquisition of real estate, plant, and equipment, a typical SBA 7A loan does not need to include the acquisition of real estate. So it's really more a question of the business that's applying for the loan. It doesn't have to have real estate. The bulk of the loans that we make at CapitalSource do have an owner-occupied component. But the distinction there is that it really can't be an investment property for which you can't use the 7A as a vehicle to invest in something, and I think that's the distinction. You don't have to physically be there, but you'd really want to have a partner who is involved or have a group of people, one of whom is there operating the business.
And just generally, what are the property management requirements, if any, for SBA financing?
Well, again, when I think about property management, I'm typically thinking about an investment property, and so I just want to make that distinction again that you could not use an SBA 7A loan, for example, to buy an apartment building or to invest in a shopping center. So, with regard to property management, it's really a question of you would want as a lender to make sure that the property was being maintained, but typically the owner of the property is the user of the property. If you imagine that it's anything from a dry cleaner or a retail store, a restaurant, a child daycare, or we've seen a lot of doctors and CPAs, attorneys, dentists who are one of the benefits to some of our borrowers of the downturn in the economy is that you imagine a dentist that can now actually purchase an office condo and fit it out and be paying about the same and sometimes less in mortgage than they were paying in rental. So, with regard to the property management, it doesn't come up as much in this product because it is an owner-occupied typically product.
How much seasoning, i.e. P&L history, does a property need for SBA financing?
The actual parameters of the credit underwriting are by and large dictated by the bank's credit policy, but I will tell you that the typical requirement is for 3 years of financing of finances and P&L from the borrower. Now, in the case of a startup, obviously you wouldn't have that if someone was starting a new business. Those, I will be honest with you, are more difficult to do now, to simply go and start a business from scratch. But typically it's 3 years of financial statements, of operating statements.
George, what is your appetite for ground-up construction and rehab, and what was your appetite this morning?
My appetite for ground-up construction is very dependent on the use. We have done ground-up construction. We like to see ground-up construction with an operator who has. We're doing a Popeye's chicken ground-up construction in the Pacific Northwest, but it's for borrowers who already have other restaurants and have deep experience. Really, when you're doing ground-up construction, you want to see management experience, and you want to get comfortable that the project being done that the entity doing the ground-up construction has enough background and enough wherewithal to complete the project. So we will do ground-up construction when we think that the borrower has sufficient operating history and we can get comfortable with that. We are, with regard to rehab, we do a lot of rehab. We do a lot of fit-out. You know, when one of these, I mentioned the medical office condos, they'll often go into the condo, which is which needs to be fit out by the developer, and we'll finance that as part of the whole package. So we do that quite a bit. In the SBA 504 world, it's a little more difficult to get ground-up construction there, just because of the structure of the 504 loan. You need to find often you need to find an interim construction loan and then have that taken out by a 504 loan. But there are lenders who are doing it. As far as my appetite this morning, I can tell you that I had a long flight from the West Coast and I didn't get dinner, so I had a big breakfast.
It seems like your appetite this morning is bigger than your appetite for construction loans, huh?
I think that's probably fair to say. Unless it's the right borrower and we feel comfortable that they can get the job done, we're always looking carefully at construction loans.
Are any new property types now eligible for SBA financing post-legislation?
Yeah, one in particular with the SBA 7A program is self-storage. Self-storage units used to fall under the category of an investment property because the was more of a passive income, but that has actually been changed just in the last few months. And so you can actually finance a self-storage facility with an SBA 7A loan. The other area that's always been a little bit of a gray area that the SBA has clarified now is with regard to hairdressers in particular, where you often have at a hairdresser or a barber shop, you'll have 6 or 8 clinicians working, and they will often lease their space and pay almost as if they were contract workers. And previously that was a gray area of whether or not that was applicable, and the SBA has clarified that, and they have become much more lenient and understanding of that type of business structure, just because a lot of these sorts of hairdressers have moved toward that business model. But the big change, though, is in the self-storage.
What criteria has to be met in order to refinance an SBA loan with another SBA loan?
That's an interesting question. You have to show a sufficient amount of savings. So let's assume that Bank A had an SBA loan currently, and I wanted to refinance that loan. I would be required to show that at least I was saving the borrower at least 10% in the fee, in the cost of the interest payments, principal and interest payments, and then I would have to contact the bank that currently has the loan, and I would have to confirm that they are not willing to either modify the loan to meet a lower rate that I can provide, or that they're not willing to make a new loan. And if they're not willing to do that, then another lending institution can refinance that loan. The primary two factors are you have to show sufficient savings to the borrower, and you have to show that the current lender was not willing to either modify or make a new loan. Now, there's a new ruling that just came out yesterday that allows SBA, the SBA 504 program was previously could not be used for refinance of loans, and that has just recently been changed so that the SBA 504 program, the one that we were just saying for plant and equipment, can actually be used for the refinance of a current loan that a borrower has. Now that is a limited time program. It's part of the it's part of this whole recovery process, and so it's called a temporary refinancing program. But you can refinance conventional commercial real estate loans, and the only catch is that it has to have been current for the last 12 months, so it can't be a problem loan, and it has to have been funded at least 2 years ago. And then one last piece is that it has to have a balloon payment coming up. In this initial round, a balloon payment coming up before December 31st of 2012. So it's really a somewhat limited program designed for people who have loans coming due here in the next 18 months who would be in trouble if they couldn't refinance those loans at a more stable rate. So it's a temporary program, but I think one that may be useful for refinancing into the 504.
What core property types, if any, have the least chance of getting financed the SBA route? Would it be hotels? Again,
I think that I wouldn't so much say that the SBA is that much different from